morning, Kinaway members, and welcome back to another episode of Kinaway TV. Before we kick things off, I'd like to acknowledge the Bundjalung people as the traditional owners of the land on which I am coming to you all from. I'd like to also acknowledge the traditional owners of the land in which each and every one of us are tuning in from, and pay respects to elders past, present, and emerging. I'd like to also extend that respect to other Indigenous peoples who are present here this morning. Before we get things underway this morning, I'd just like to take a moment to remind our viewers of the support services currently available for Kinaway members. The first support package on offer, which is in collaboration with Kinaway member Claystone Marketing, is free access to Claystone's social media and marketing course. The course provides an overview of social media marketing strategies and tools, which helps highlight marketing opportunities for Indigenous businesses. It's a great resource and it's really helpful for businesses looking to solidify their online presence. In another collaborative effort, Kinaway is excited to partner with Boost Legal Templates. Designed for small businesses, Boost Legal Templates gives you clarity, safety, and access to real quality legal templates. Just complete the friendly questionnaire and you'll instantly receive your own legal template, which you can take pride in knowing it has been created specifically for your business. This collaboration will save member businesses time, money, and ensures businesses are on the go while implementing good business governance. Kinaway is proud to offer members a 25% discount across all Boost Legal Templates. So if you feel this is something that you may be interested in, please contact the Kinaway team. Another support package we're looking to deliver is support for our member businesses around digital capabilities, whether it be website development, e-commerce capabilities, social media and marketing, and many other components surrounding a business and its digital presence. So if this is something that you feel you may be interested in, please keep an eye out for this also. I'd like to also mention the confidential phone crisis line for Victorian Aboriginal and Torres Strait Islander people, launched by the Victorian Aboriginal Health Service. The service is for Indigenous people and families who feel they may need to have a yarn with someone about their wellbeing. This 1-800 helpline is a statewide social and emotional wellbeing service, and whose number is 1-800 95 9563. This service operates 7 days a week from 12 p.m. to 10 p.m. And finally, there are plenty of webinars on various topics available on our Facebook and YouTube channels. So please feel free to jump on at any stage and make yourself familiar with the content. Along with these webinars and support packages mentioned, Kinaway is still offering the usual forms of business support for our members. So if you feel you may need assistance or support of any kind, please feel free to get into contact with the team here at Kinaway. For this morning, we're pleased to be hosting the third and final episode of a series revolving around financial planning, with the goal of ultimately helping those people participating to be better positioned to create generational wealth. For those that missed the first webinar, it is still available to view on both the Kinaway Facebook and YouTube channels, and is a discussion on how to effectively manage your financial affairs, particularly for those in the infancy of their money earning capacity. While the second episode, again available on the Kinaway Facebook and YouTube channels, touches on some important features of superannuation. For this morning's webinar, it is a discussion around the benefits of investing for Indigenous people. Joining myself to discuss such a topic, I'm pleased to welcome back both Brian Wyborn and Phil Usher, who have featured on previous webinars throughout this series. Before I introduce today's panelists, I'd just like to note, please be aware that the information provided is factual in use only and is not intended to be financial product advice, legal advice, or tax advice, and should not be relied upon as such. The information is general in nature and may omit details that could be significant to your particular circumstances. Moving on, for anyone who may have missed the previous two webinars, I'll do a quick little intro for both Phil and Brian. Phil Usher is the First Nations Foundation's CEO. Phil maintains a strong connection from his childhood growing up amongst the rich culture of the Gamilaroi people in Tamworth, and has family roots that make him a proud Wiradjuri man from central New South Wales. Phil obtained a Bachelor of Business at the University of Newcastle before establishing an extensive career in the industry. Successful in his role as a business advisor, he now runs an investing education business offering digestible education to everyday Australians looking to build their investment portfolio. Driven by a personal vision to empower Indigenous Australians with world-class financial education, Phil joined First Nations Foundation as Treasurer in 2017, ensuring the stringent financial foundation of processes, procedures, and controls. Embodying the spirit of the national not-for-profit organisation, Phil was appointed CEO at the beginning of 2020, eager to continue his expertise to contribute to the financial literacy and prosperity of all Indigenous Australians. And joining Phil, we have Brian Wyborn. Brian is a proud Torres Strait Islander and Senior Wealth Advisor at JB Ware. Brian holds a Masters of Financial Planning, Bachelor of Business, and has completed the Australian Institute of Company Directors Foundations of Directorship course. Brian is also a Commissioner for Declarations, accredited financial planner with the Financial Planning Association of Australia, tax advisor with the Tax Practitioners Board, and affiliate member of the AICD. Outside of his private wealth advisory role, Brian holds a non-executive director position and is a current serving member of the Australian Army Reserve. I'd like to welcome both Brian and Phil to join me this morning.
Thank you, James. Glad to be here.
Pleasure. Brian and Phil, thanks for joining us this morning. Phil, we'll get straight into things. And I know that we touched on it in last week's webinar, but for those who may have missed it, can you tell us a little bit about First Nations Foundation and the sort of support services that you provide?
Yeah, sure. So First Nations Foundation focuses on achieving financial prosperity for Indigenous Australians. So we work really well with people that have sort of got a bit of a foundation set up. They've got some income and they're looking to really build a substantial, asset that they can potentially pass on to future generations. Two key things that we do. One is our big Super Day Out event, where we take Centrelink Tax Office, superannuation funds, as well as financial counsellors out to community, and we help community find super that they didn't know that they had. So been doing that for a bit over 6 years, been out to 16 communities and found a total of 24 million super so far. So just a tad over $1 million for each place that we're going to. And then the other part we do is also online financial education training. So you jump online, you go through our program, learn about money, learn about budgeting, some of the historical significance of economics for Aboriginal people, and then learn about some of the cool stuff like insurance and superannuation.
Absolutely. Thanks, Phil. And Brian, similar for yourself, you did join us for the first week of this series. But again, for anyone who may have missed it, can you tell us a little bit about your role as Senior Wealth Advisor at JB Ware?
Yeah, for sure. Really quick. Yeah, before I go, I just want to acknowledge the traditional owners of the land. I'm here in Brizzy, so it's the Turrbal and Yagara people, and acknowledge the elders past, present, and emerging as well. I'm a private wealth advisor, so I work with a firm called JB Ware. I work with both individuals all the way to institutions like charitable organisations as well, typically in the investment space. So talking about them, everything from where should I be putting my money, looking at where TD term deposits are and where cash rates are, and looking at alternatives outside of that, staying quite defensive, all the way up the spectrum to looking at equity. So keen to get into this topic today and flesh it out a bit more. But in that space, yeah, so I work with some of Australia's most successful individuals, all the way up to ASX listed company directors, all the way to charitable organisations, and particularly that that's the bit I'm real passionate about, because I get to work with mob as well. I get to work with Indigenous organisations across the spectrum, from health, education, all the way to native title, and talking about future funds and how that creates economic prosperity for their people and their communities. So yeah, mate, really keen to be here and get my teeth stuck into this chat.
Absolutely. Speaking of getting stuck in, we'll get things underway. So Brian, I'll stick with you. Just touch on investing. Can you tell us, what is investing and why is it so important?
Yeah, okay. Well, I might take a step back, right? I think particularly for Indigenous Australians, this is probably the first and second generations where Indigenous Australians have really participated in the economy and greater workforce for that matter. And I started to see significant amount of wealth being generated in that middle class as well. So I think, investing and the concepts of investing is really important for our people. So I want to be a part of that conversation. Mate, really, basically, I look at investing as an allocation of capital. We all have capital, right? And a really quick example for me is time. My time is capital. How do I allocate that capital and receive a return? And one way I do that is I got a job. I go and I work. I give away my time for a period, and it's typically a month. At the end of that month, I get given a return and I get paid a wage. So I allocate my capital. There's time involved in allocating that capital. There's an opportunity cost in allocating that capital. And then at the end of that period, I receive a return. Now, there's risk in that. What if my employer doesn't pay me? So there is always risk in allocating capital, and is what level of risk are you willing to take on? So for me, investing is very much the same. So if we utilize that analogy, it's just the same thing. You are allocating your capital with the hope of a return somewhere along the line. So, really basic terms. I've got cash in my bank account. What can I do with that to generate additional return? I can stick it in the term deposit. At the end of that period, call it 90 days, call it a year, call it 2 years, I hope to get my capital back. But in that period, I also hope to get a return from interest. Equities work very similar. It's about allocating your capital, understanding that there's time and risk involved, and equities have a bit more risk involved with that. And there's two types of return spectrums we've got to look at, both how much has it grown and has it paid me income, and the risk and the duration that you put it away for and the risk involved in that time frame as well. So it's an allocation of capital to generate a return.
Absolutely. Thanks, Brian. Phil, is there anything that you'd like to add? I know that you joined us last week for the superannuation discussion. For those viewing, can superannuation be viewed as a form of investment? And what is the importance of both superannuation as an investment tool and just investing in general?
Yeah, so I'll start with the investing in general, and it's to keep, for me, it's to keep the value of your money real. So one of the examples I like telling people, let's imagine it's 1975 and you've saved up, or your parents have saved up $5,000 and they want to buy a brand new car. But they think, let's wait, let's hold on, and we'll put this under our mattress. And when we have a son and he turns 21, we'll give it to him to buy a brand new car. So fast forward to 2020. They pull the $5,000 out from the mattress and they say, "Here, son, go buy a brand new car at the car lot." People are going to laugh at you if you walk into a car lot expecting to get a brand new car for $5,000. The money itself hasn't actually changed. The power or the buying power has changed a lot over that, 20, 30, 40 years. So you want to try and invest it so you keep the power of that money increasing over a period of time. And different asset classes are just usually depends how much of a return you get over that period of time. And superannuation itself can cover all those asset classes at once, right? Like you can be invested in cash and property and bonds and shares. It's not a separate thing. It's something that can include all those asset classes. So it can be really, really effective in just getting immediate exposure to the full classes.
Absolutely, thanks, Phil. And what are the main assets that you can invest in? Phil, I'll let you start.
Yeah, so there's broadly four. So you have cash, so term deposits, the bank offer. You have bonds, so it can be government bonds or corporate bonds. So that's where they, if a government or a company need to raise money to fund a project, they might issue what's called a bond, and you get a yield on that, and then you get your cash back at the end of a certain period of time. You've got property, so that could be residential property that we see, commercial property. And listed property as well, where they pull it together in what's called a real estate investment trust. And we've got stocks, buying and selling shares on the stock market.
Absolutely. And Brian, are there any other sort of assets available to invest in? And from the ones that Phil did mention, are there any that are more preferred over others?
Yeah, what I'll do is I'll just categorize those, I guess, and build on what Phil spoke about as well. So we try to put them in two buckets. One is that defensive bucket that either generates a nominal rate of return and has a capital preservation element to it. Typically, traditionally, you'd put your bonds and your cash into that bucket, into your fixed interest. So they typically make up your defensive part of your portfolio. Now, look, a lot of that's probably changed with what COVID's done and how we actually see that. So we can do a bit more of a deep dive into where we see bonds, particularly where interest rates are and how it's just eroded that yield. We can dive into that a bit more. The other asset class is your growth asset class. So that's where your property and your shares fit into that bucket. Look, the two key main elements of those asset classes, they do two things for you. Ideally, you want it to generate a level of income, and with property, we all will understand to a certain extent that if I have an investment property, I want the value of that property to grow over a period of time. But also in that time, if I have tenants in there that are renting it, I want them to pay rent, right? I want there to be a level of income that it generates across there. Look, property and equities work in a very similar way. It's that you want to have a growth component to it, and you also want to have some level of income it generates as well. And they're the main two buckets when you're looking to develop a portfolio that you'd want to look into.
Absolutely. And Ryan, while investing in assets, what are some key investment principles that should be applied?
Yeah, look, I think with a lot of things, being a financial advisor by trade is we got to go back to the start. And for me, it's all about planning and understanding what is this investment supposed to do for me. I think most people go into investing without having a plan, and that's one of the worst things you can do, because you don't know when to get into the market or get out of the market. You're not really certain what is this investment supposed to be doing for me and my family and my broader community, for that matter. So I think, whether I talk to an individual or whether I talk to a native title body, the planning bit and the governance and the structure you put around it is so important, because it drives the whole conversation. So if you're a young family and you're looking to invest, whether it's for your kids' future education or whether it's for retirement, understand what that journey is and why you're investing in it. That's probably the first and most critical part, is have a plan around it, because that plan will then inform what sort of risk you're willing to take on. What is the time and the duration I want to see this investment in the market for to generate X amount of return? Do I need it to start generating a return from day dot? And so for some of my clients, that's a conversation we need to have, just to say, well, how are we going to generate? Where are we going to allocate our capital so that we can start to generate a return tomorrow or a year, ideally? You don't want to be going into the market if you've got to pull it all down in 1 or 2 years. That you're better off sticking it in cash and not taking the risk, right? So having that plan, understanding your time and your duration, but then understanding yourself personally. How comfortable am I to see something underperforming? If I put money away and the market tanked like it did in March, how long do I sit on the sidelines, and how comfortable am I with seeing that drop, call it north of 30-odd%. So I think it's not only having that plan, it's just understanding yourself and your own human psychology and your behavioral science around that to then, make sure that you're putting in strategy so you kind of mitigate and doing something silly like selling down straight at the point and then go, no, I'm going to stick it in cash now. You're not going to make that up for a long time. So have a plan. Understand yourself to then understand where you're going to allocate your capital into the different asset classes. And that's probably the next piece. It's diversifying. You want to have a diversified strategy, putting your money not all in the one basket, but spreading it across different baskets. And that has different components to it, right? You're not only going to give yourself access to different return profiles, you're also going to spread that risk across the different baskets, where in an ideal world, when one basket is underperforming, you want the other basket to kind of preserve that capital and ensure that it's ticking along. And look, one of the other things is no one has a crystal ball. As much as people can be out there saying that, oh yes, I timed the GFC and this happened and that happened, to consistently do that over time is a really, really hard thing. We don't profess to be, wizards when it comes to trying to predict a market. Yes, we try and make educated and informed opinions and take positions, because you're better off taking a position and playing in the market than sitting on the sideline and letting your cash erode with inflation, right? So we can dive into that a bit more, because that's, I think, a really important point for where we are now. But the point for me is have that plan, have that strategy, don't time the market. Dollar cost average into the market. So what I mean by that is having regular intervals where you're buying or you're purchasing your broad investment asset class, and doing that over time, and not trying to time the market to say that, okay, I think this is the bottom. You're never going to pick the bottom. You're never going to pick the top. But if you pick somewhere in that range, you're going to have a better outcome for your investment. So they're probably the key things for me. It's have a plan, understand yourself personally and the different buckets that you want to put your money into in the growth. So understand your risk tolerance and your risk profile. Ensure that you diversify across the different asset classes. And then thirdly, don't try time to market. No one has a crystal ball. Just dollar cost average your way in at regular intervals.
Absolutely. Thanks, Brian. And Phil, from your sort of perspective, are there any other, key investment sort of principles that you'd like to add to what Brian mentioned?
Yeah, I just look at 3 points when we're looking at investing. It's time, money, and risk are the three elements. And if you're looking to double your money in 12 months, that means you need 100% return. So you're going to have to take on a pretty big risk. You're going to have to be willing to lose 100% in that 12-month period. Whereas you want to double your money in 10 years, then you can take, sort of a medium risk. You might put in the stock market and settle for 7% return. So it's all about kind of molding that risk to return to that time frame as well. And that's why superannuation is good, right? You've always got that money going in. That's dollar cost averaging, like Brian said. Every quarter, your boss is paying you $400 or $500 into your super, so that goes into the market all the time. You've got a long time frame. You've got 30 to 40 years where it's just accumulating over, and then you've got that risk that you can go in and change. If you're 20 years old and you're not retiring for another 40 years, maybe you could be aggressive because you've got plenty of time to wait for the market to go back up if it's fallen down. But if you're transitioning to retirement, you may not want to be all in these speculation shares in Southeast Asia, for example, because if they tank tomorrow and you're looking to retire next week, you're going to be in for a tight retirement. So I think it's about time, money, and risk. Just having a look at that and seeing where that fits in with your goal.
I'll just add on to it, James. If you don't mind, I'll just jump in really quickly. What Phil talked about, particularly around superannuation, it is one of the most tax effective structures. So, to Phil's point before, I don't see superannuation as a product. I see it as a structure, which it is a structure. It is a 15% tax environment rather than growing an asset in your own name. So you own it personally, and when it generates income and when that income's come into your household, you pay your marginal tax on it, or when you sell it, you incur capital gains in your name. This thing, superannuation, it's like the eighth wonder of the world, right? It's a 15% tax environment, and that's all it is. It's a tax environment. You choose the structure of what you're going to hold in there. You choose your risk. You choose your, duration to when you want to see it mature. But guess what? It's 15% tax rather than your marginal tax rate, depending on where you're earning, right? Whatever your marginal tax rate would be. But here's the kicker. Once it ticks over into that pension environment, there's 0% tax. And particularly when you're coming into retirement and when we're thinking about long-term savings, you want to, if you imagine a Gantt chart with the different things falling and different projects ending, think about your wealth in the same way. When do I access it and how do I do it? It will help with your duration planning. But that's the kicker, right? Once you're in pension phase, it's a 0% tax environment.
Absolutely. Thanks, Brian. Phil, I'll throw it back to you. For those wanting to get into investing, how do they get started?
Yeah, I think a lot of investing is really around confidence, and people like to kind of dip their toes in the water. One of the things that I get people to have a look at is this company called Raise. So what they do is they give you access to index funds or ETFs, which are kind of tools to invest in the stock market. Like you'll automatically invest in the top 200 companies in Australia, for example. So you get that diversification and you get a bit of that potential return. So the way it works is you might be buying coffee every day for $4.50. And then what they do is they'll round that up to $5, and that 50 cents will go into your investment account. So that's a really cool micro way to get used to the market. And you can put regular amounts in there as well. You can put $100 every month. And that way you get to log in, you get to watch it grow, you get to watch it go down, you get to see how you respond to the market. If you're sitting there, and it doesn't matter whether it's $100 or it's $100,000, and you see it go down by 40%, if that's your first time investing, it's going to make you pretty nervous, right? So you've got to take note on how you react to that. And if you see that and then you want to sell or you want to get out just in that level, that gives you a bit of information about kind of your risk profile as well. So it's good to jump in this micro level and start to make some of those mistakes when they're not sort of as devastating. So for me, getting started in shares in particular, something like Raise is really good. And then once you build up that confidence level, and you've got to go in increments, right? You see, you can't go from $0 to $100,000 and trying to manage your own funds. And that's why a lot of people that win the lottery go broke. Like they usually go from low incomes to winning $200 million, but they don't know how to handle that much money. So if you start off with a portfolio of, $100 to $1,000 to $2,000 to $5,000 to $10,000, you can really build it and build your confidence. And that's where you might take it out of that. Then you might go see someone like Brian who can sort of structure that in a much more sophisticated way and start taking advantage of some of that tax stuff that we hear about.
Absolutely. Thanks, Phil. It's funny that you mentioned Raise because I actually do have it sitting on my phone at the moment. And I noticed myself, kind of sitting there at night looking at it and it's important. It's interesting, like you say, to note your kind of reaction, because I definitely do get those sort of reactions when I look at it. So, Brian, I know that Phil did mention, just that raise kind of app, and that is a sort of practical way. Is there any sort of resources that maybe that we should access, as well as a practical sort of way of getting into the market? Is there any sort of resources that we should read or look into as well?
Yeah, for sure, James. I'll build on what Phil said before. It's all about confidence, right? I think when you don't know something, you're a lot more hesitant about it. But look, guess what? Most of us that have held a job before, we're all investors because we've at some point would have had superannuation paid into a fund. Whether that fund's lost now and you need to go find it, or it's you keep track of it. For me, it's about it's all about education, right? It's about understanding what you're doing before you're jumping in. So, for a really easy way to start is to have a look at your superannuation statement, take an active position in how you want that to be invested, understand the metrics of how they stick you in their balanced portfolio or the growth portfolio. What does that actually mean for me? They might say that if you're X age, you should go in the balanced portfolio. Understand yourself first and go, okay, does that actually work for me, or am I comfortable to take more risk, or should I be having more of a diversified, a conservative approach? So my first starting point is understand the market, get into your superannuation, see what it looks like, and make an active decision about how you want that to be invested. Then to build on to what Phil said before, what are the options we have when we're actually looking at it, and what are the different ways that we can do it? What platforms are out there? So you can either look at a platform where it then allows you to buy, say, things like ETFs, managed funds, or direct stocks in there as well. So understand the different platforms you have in the market. And I think when you're actually doing that, understand those products. What is an ETF? How does that get traded on the market? And like yourself doing at the moment, James, is when you're looking at that product, understand what's invested in the background, why is it moving around, and then break those products down a little bit more. So a managed fund, what is a managed fund? Effectively, you're buying a unit within a broader trust structure that has a professional manager that sits on top that makes decisions for you. And now understand those decisions. Are they active decisions or are they passive decisions? So just understand the two different types of investing. There's passive investing and there's active investing. In short, a passive investor says, I think the top 50 companies in Australia are going to do really well. I'll buy those top 50 companies. There might be companies that come in and out of the top 50, but I think the top 50 will always do well. Build your own investment philosophy as you educate yourself. Then you have an active manager to say that, well, my universe is more like the top 200. Of those top 200 companies in the Aussie market, I'm probably only going to invest in between 30 to 50 companies. I want to take an active position in there. I'm going to read their balance sheet as the fund manager. I'm going to go up, catch up with the CEO, catch up with the CFO, have a human interaction with them and get a feel for them. Do I think they're a really good management company? Then come back and then relook at the numbers again and apply my methodology when it comes to investing and understand it from a balance sheet bottom-up approach. So for me, it's all about education. I think there's a ton of products there that can help you get into the market, particularly with where technology is now. The product you mentioned before, what an amazing product to get people into the market and what I'd say is understand the background. Where are they making their money? Where is it being clipped on either side of the buy spread to understand it? So for me, it's about education of the market, but also education on the platforms and how they work, and then building an underlying investment philosophy to do that.
Sure. And I know you just touched on about the education of the market, things like, can you just explain a bit about the difference between, the bonds and stocks as well?
Yeah. Okay, cool. So effectively what Phil said before, a bond is when either a corporate or a government needs to raise capital. There's different risk profiles to that, right? Your government bonds, particularly when you're looking at your stronger economies, when they put out a bond, it is pretty secure. The main risk you're taking on when you're looking at, so I'll talk solely about bonds and then we'll move across to equities. When we're looking at bonds, we look at it in two types, a government bond and a corporate bond. So government bonds tend to be quite secure. The biggest risk with government bonds is one, obviously, is the duration to the end where you receive your parcel of money back. But you got to understand, where are we in the market when it comes to inflation and interest rates. So government bonds, the biggest risk with government bonds is inflation and interest. Given where we are at the moment, the very compressed yields on government bonds, particularly your long-ended bonds, effectively it's the same and worse than sticking it in cash. So understand, just even with cash, right? If you stick your money in cash from a term deposit, not just look at the term deposit rate that they're giving you. So at the moment, at a glance, for a 1 year, even at a 3 year or 5 year TD, you're probably going to sit around at 0.6%. That's what the bank's offering you. What does that mean when Phil talked about it before, about sticking your money underneath the mattress and the power and the power of the money? That sticking it in a TD, you're actually going backwards once you look at a real return compared to your nominal return. So you take away your inflation, what is your buying power? You're doing yourself any service there. So really understanding that component, government bonds, understand where we are in the interest rate environment and what that's doing on the long-term yields. Then we look at equities. So most people have been pushed into equities, and part of what the government's done when it comes to this quantitative easing and low interest rate environment is to push people into more riskier things. Now, a corporate, like a company, they can raise capital in two ways. They can do it through shares, or they can do it through debt or bonds. So a corporate bond works similar to a government bond. The difference with a corporate bond is you're taking on the company's credit risk. So it's their ability to repay you. It's a loan. It's effectively a loan to a corporate, and they're paying you. Nominal coupons are on that period to when it matures. What you're taking on there is their credit risk, their ability to make repayments to you. So when you're looking at bonds, they're the two types. Government bond, risk is inflation and risk is interest rate. When you're looking at corporate bonds, the risk is that company's ability to make those repayments to you. Okay, so they're your defensive class, they're your bonds. When you look at equities, there's the two components to it, right? Equities is you're seeking greater risk in there. So you're looking at their balance cards. So you're looking at their net assets. You're looking at can they win business? Are they going to grow as a business? So I put a really, really easy lens on. If a company is paying out dividends, effectively they've saturated majority of their market, right? There's not a lot of space to grow. So they then return the capital to their investors via a dividend, and they try and do a balancing act of that. A growth company, it's identified a ton of opportunities that they can continually grow their business. So rather than paying you an income, they will reinvest into the business to grow it. So they're your two profiles you look at when you're looking at investing. What's the growth of this company, and what's the income that it can generate off me? And when you're buying a share, you're physically buying a piece of that company. You're entitled to it. That is, you are. I know we think of it as an intangible thing. No, it's a tangible thing. When you buy Woolies, you're buying a piece of that company, and you're gonna get a return on it, whether that's in the form of growth, negative and positive growth. I'll add at the same time as hopefully a return on your capital in the form of a dividend.
Absolutely, thanks, Brian. Phil, going back to you, I know that Brian alluded to inflation earlier, and I know that you mentioned it earlier on in this discussion as well. Can you just briefly describe what inflation is and what it means for people out there that are earning money and having it in cash or in their savings accounts?
Yeah, just in its simplest terms, it's the increase of goods and services going up every year. My parents always spoke about how far 20 cents would go. You go to the shop, buy, get some lollies, get some feed. You're not getting any of that these days. And it's because those prices are continually changed over a period of time. One of the ways I had it explained to me when I was reading the book, it's like you got $10, you go to the shop and you want to buy footy cards and they're $1 each. But, you wait till next year and you go back there and now they're $1.05 each. When you're saying $10 can't go buy 10 cards anymore, you can only get 9. So your money's kind of decreasing because it goes up every year. Generally, a long-term goal for inflation is sort of between 2 to 3%. That means the cost of goods and services will go up around 2 to 3% each year. Now they can vary. The stuff at Woolies, might go up 2 to 3%, but things like alcohol might be going up 10% per year. Electricity might be going up 8%. So it really varies on the category. The reason that investing is important is because you want to keep up, bare minimum, you want to keep up with inflation. You want to get at least 2 to 3% return per year. If you're not doing that, then your money's actually going backwards. And that's what Brian was talking about earlier. If you just put it in a term deposit and even get 1%, then that actual power of your money is going backwards because things are getting more expensive and your money's not keeping up with that rate of inflation. So usually when you're investing, it's a common thing that people will say inflation plus. So they might say that might mean 3%, which is inflation, plus an extra 4% on top of that. So the bare minimum is you want your investment to keep up with the rate of inflation.
Absolutely. Thanks, Phil. I'm a bit conscious of time. We have had plenty of questions come through. So I'll ask one more question of you both. And, this is about creating wealth and intergenerational wealth as well. So, Phil, what are some good ways for educating the kids around the importance of money and investing?
Yeah, it's a good question. I don't have little ones, so I can talk from a really theoretical point of view until we actually get it out there. One cheeky thing I say is, if you want to build wealth for your kids, instead of buying an iPad, go buy Apple shares and then give that to them in 20 years' time. They might like it for that 20 years, but after that, I reckon they'll do all right. But I think.
I was just going to say, I'd love to see that fly past your 15-year-old.
But I think the advantage of investing for kids is if you've got a long period of time, right? If you've got a 4 or 5-year-old and you're looking to build wealth for when they're 21, that's a good investment time frame. So you don't need to be thinking massive amounts. You could be putting away $50 sort of a month and have that compounding at, sort of 7 or 8% return per year. So I think just simple little structures for that around setting that up and always having conversation about money. I think money is really taboo in Australia to talk about. I think the more we open it up and the more we get it out there, because it's not really taught in schools to a great extent at the moment. I think talking about your paycheck, talking about the bills when kids start to get into that teenage years, I think can be really, really powerful.
Absolutely. Thanks, Phil. And Brian, I know that you do have some little ones, so is there anything that you'd like to add on teaching, little ones around the importance of money and investing?
Oh, my oldest of my little ones is 4. So the biggest thing I try and talk to them about is opportunity cost, right, and delayed satisfaction. So, for me, it's about giving them active choices when it comes to opportunity cost, and money works in a similar way, right? What's the opportunity cost of blowing money now or putting it aside and reaping the benefits of it later? So I try and talk, and particularly at this age, in really simplistic terms around understanding opportunity cost, because at some point I'll start to overlay that with money. So when we go, and you have this all the time, I'm like, no, baby, if we buy you a chocolate now, it doesn't mean I can get you your Christmas present. Well, no, sorry, I've got to give money to Santa to get a Christmas present. So I talk about opportunity cost is probably the really big one, to say that if we do this, it means we can't do that. What do you want? And let them start making those active decisions. And I try and put duration premium in that, to say that if we give away a small thing now, we might have that duration premium at the end to get something that's a little bit larger. So they're 2 really simple things I try and implement at home: is opportunity cost of doing this now, and then trying to build duration into it, that they get something before, which has that delayed satisfaction piece. Because I think we live in a pretty hedonistic world, right? And particularly now, where everything's instantaneous. And mate, I see it now that they're just so switched on with when it comes to things like phone, easy access. I'm like, I had to wait for ads to finish to get back into a TV show. They watch TV and they get restless. So they're like, Dad, what is this? And I'm like, it's ads. It's a way that these companies make money. But anyway, that's another topic. Is that it's so instantaneous? Is how do we build in a delayed satisfaction?
Absolutely. Well, Brian and Phil, thanks for joining us this morning. Some really valuable information provided throughout, and we have received plenty of questions as well from our viewers. So we might spend the next 5 to 10 minutes just taking a few questions from our viewers. And the first one is from Kate, and she says, "Thanks, Brian and Phil. Is there any way I can use my super to invest in property, bonds, or stocks?" Phil, I'll let you have that one.
Yeah, so there's probably two answers to this. I know super funds have become really good over the last few years. We can actually go in and change your investment mix. I know I'm with Q Super, and I can log in, and it gives me a whole range of things where I can say I want to put money in Australian property, or I want to put money into US stocks, or do a blend of both. You can jump in and take a certain element of control as to where you allocate your money. So that's probably a bit more detailed, but you can do it more broadly. You might go take a balanced approach, and you're automatically going to get exposure to property and shares with that as well. The other part is, which is depending on your balance, is looking at that self-managed super fund, which is a bit more complicated, but that's where you have ultimate control over where it is that you invest. And if you're particularly looking at property and commercial or residential property in your super fund, that's the avenue that you can take with that. But outside of that, it's really that listed property.
Absolutely. Thanks, Phil, and thanks, Kate, for the question. The next one we have it's from Steve. He says, "Hi. With the cash rate being dropped, what does that mean for my savings account? Am I better off withdrawing it and investing elsewhere?" Brian.
Yeah, for sure, mate. I'll just reinforce your disclaimer at the start. Without understanding your personal situation, I guess it's cognizant of me making sure that we put it out there. To be honest, you need to understand where you are in your life stage to be making a decision like that and understanding that vacuum. So in general terms here, Steve, I'd say, yes, cash in the short term is going backwards, and we touched on that earlier. If you wanted to generate a return, you have to move up the risk curve to do that, whether that's staying in the fixed interest space or whether that's moving. And again, it's how much capital do you have to be able to do that. My first port of call is to go back and say, well, what do I need in the short to medium term? Am I going to need to draw down on that? Because if you're going to stick it in the stock market, you want something that's you're happy to see run for at least that 3 to 5 years, particularly where we are seeing growth is, in short, everyone needs to get comfortable with lower returns is probably the biggest thing we're going to see. We're going to see a period of depressed returns. Governments are going to need to pay back this debt that they're generating, that they're pumping this stim into the economy, means that growth in general is going to be lower for a call it 5+ year period. So I think everyone needs to get really comfortable that growth and return spectrums may be a whole lot more compressed than what we used to have. So that's just probably a general term. But for Steve, I'd say, Steve, what do you need your capital to do? If you need to be drawing on capital in the short term, you're better off leaving it where it is. If you don't need to draw on capital, it's then saying, well, if there's an emergency, do I have enough capital on the reserves to be able to draw into? Cover all your bases there first before you start to move up the risk spectrum. In general, yes, sticking money in TDs for a long period of time, it's going to go backwards. You have to move up the risk curve if you want to generate additional return, but do that with your own personal circumstance overlaid across the top, because, I'd hate to say, yes, go equities, but you actually need to pull it down in a year's time to buy a car. That's just a dumb thing to do, and I wouldn't suggest doing that. So Steve, mate, my response is quite lengthy in the sense in short, it's understand where you are, what time frame you have, and yes, you may need to move up the risk curve.
Sure. Thanks, Brian, and thanks Steve for the question. We'll take a couple more. The next one's from Frank, and he says, "Thanks for this morning. I'm sure you've had this question before. Should I invest in cryptocurrency? I recently read Bitcoin is having good returns." Who wants to have this one? I'll leave this one up.
Yeah, I think it's an interesting space. It's really a tech solution at the moment. Cryptocurrency is more than probably a sophisticated asset class. I mean, for my personal investment portfolio, I always have 5% in speculation. So whether that's cryptocurrencies or a stock listing on the market for the first time, and it's part that you're prepared to sort of lose. But it's more about the tech solution. Cryptocurrency is all about having this general ledger of accounts and having a speed of payment and not being able to track that payment. So it's more an ends to a mean at the moment. And the point where cryptocurrency or Bitcoin in particular becomes powerful is when you don't actually compare it to an Australian dollar, where everyone's just accepting Bitcoin. It's 2 Bitcoin to buy a house, or it's a third of a percent of Bitcoin to buy a feed down at the shop. That's where it's sort of powerful. So it's a really, really alternate asset class. But look at the tech behind the cryptocurrency. And one of the best examples I give is it's kind of like going to the casino, right? You hand over $100, they give you $100 worth of chips. Those chips are only useful in that sort of environment. If you take those out and then try and pay your rent with it, it's not going to work. So some of the cryptocurrencies are the same. They only work within that specific kind of environment. You can't necessarily cash it in, or you can't use it sort of elsewhere. That's a very quick high-level overview of cryptocurrencies and Bitcoin.
Sure. Thanks, Phil. Thanks, Frank, for that question. We'll take 2 more questions. So the second last will be from Gemma. And she asks, from what I understand, gold can be a good investment. Is it preferred time invest in gold, and what makes it such a good investment? Brian.
Yeah, cool. I'll jump in on that one. Look, gold. I throw gold in a class of what we term as alternatives or uncorrelated strategies. So, what gold does to a portfolio, it generates a return that is not symmetric with whichever way the market's moving in either the defensive or the growth asset classes. So for me, gold is a diversifier again, and it's coming back to that strategy about diversifying money, right? You want to stick some in your defensive, some in your growth, but you also want to stick some in what we call uncorrelated strategies. So where gold sits and when to buy it will differ on the timing of going in, unfortunately. But if you go in with that broad strategy to say that I want to have X percent, call it 30% defensive, a portion in growth, and a portion in alternatives to diversify out of that. So for me, gold is another uncorrelated strategy, and there's a whole heap of uncorrelated strategies you can look at. Some of those include buying private equity. Some of those looking at unlisted options of investing where you don't buy it on the ASX. There's a whole heap of different uncorrelated strategies to look at, and gold is one of them. So for me, think broadly about gold is just a undifferentiated way to still generate an income.
Absolutely. Thanks, Brian, and thank you, Gemma. For our final question for this morning, it is from Gregory, and he asks, how much money do I need to start investing? Phil, I'll let you start.
Yeah, not much. You can kind of kick off with $50, like we were talking about raise before. It's not so much about, I think 10, 15 years ago, I might have been saving 10 grand and sort of getting into the market that way. But something like raise, you can put $50 into your account. I know CommSec, Commonwealth Bank's trading platform. If you're buying shares, the minimum's 500 there. And then there's all these different platforms where you can buy property, right? You can jump in. There's one called BrickX, where you it's kind of like a real estate investment trust. So that's where a whole heap of people pull their money together and then they go buy property. So you can get started in something like that for $100-200. So I think it's not as much as people think it is, and it's actually good to start in those smaller amounts. Like I said before, go up in increments, and you get more comfortable once you get to those bigger amounts.
Sure, Brian, I'll leave with you. Is there anything else that you'd like to add to what Phil mentioned?
I think Phil's covered it off there. It's about building out your plan, starting in increments. There's a ton of platforms and technology out there. I won't pitch for any in particular, but there's platforms like Phil's mentioned. There's nearly every bank has a trade-in platform. There are also platforms which then allow you to purchase things like managed funds under. So there are different providers out there. Not only do the banks offer that, you have private platforms that allow you to do that as well. So it depends on how actively you're going to go into these things and how regular you are with them. That is probably where you need to come back to understand where you are in the journey to then access those platforms to start investing.
Absolutely. Thanks for that final question. And Brian and Phil, some really valuable information throughout both today's webinar and the previous webinars that we had you both involved with, which I'm sure the viewers appreciate. So on behalf of Kinaway and our members, we'd just like to thank you both for joining us this morning. And for the previous weeks also.
Mate, thank you very much. It's been a pleasure being here. I love talking about this stuff, particularly with Mob.
Yeah, really appreciate it. No, I must apologise for not wearing the white polo as well. Yeah. Well, yeah, once again, Brian and Phil, thanks for joining us. For everyone else, before we go, we do have a special guest joining us briefly to announce some news. I'd like to welcome Kinaway's very own CEO, Scott McCartney, to make an announcement.
Hey, thanks, James. And just in the future, mate, leave the jokes up to me. All right. So that wasn't quite that funny. No, look, we do have some. It's more a bit of an update for our members. Look, we've got some really exciting announcements over the next few weeks that I think will be very well welcomed amongst our business community. But look, just wanted to talk today. Look, there's a lot of information out there at the moment. And there's lots of gaps in that data that's out there. And I think if the members that we joined us prior to March this year, we did a survey of our members, and we got some great response, which was then allowed us to actually go to government and say, hey, these are the areas we need support to deliver, the support mechanisms and the collaboration that we'd actually go and help our members get through COVID. Now, coming out of COVID, and look, what's normal? We don't know. What's COVID normal? We're not really sure. But we thought it's another opportunity now to go back to our members and get a bit of a temperature check to see where things are at. And look, I know we all get sick and tired of doing surveys. The survey we're doing this time around is going to be the survey of all surveys. It's going to have some really good data in there that I think it's something that we'll probably try and do every year around this time of year to get a bit of a temperature check to see where things are at and where the opportunities may lay in the future, but also around what support mechanisms or scaffolds we can put around our businesses to ensure they continue to prosper. Now, I know, like I said, we all get sick of doing surveys, but what we have done for this particular one, we've been able to hit up all our corporate partners, and we've got about $60,000 in incentives for our members to complete the survey. So when you do this survey, you will receive a minimum of about $150 of prizes. And I'm talking there's Visa card vouchers, wine vouchers. There's even a carpet steaming voucher for some reason, and someone might have a dirty office or something or a house, they can use it. There's artwork. Nagali have donated a scarf. We've got some corporate boxes that we're going to give our members as well. So look, it's really important that we, that when we do this survey, that we be as accurate as we can and treat it with the respect that we need, and that's to get that temperature check where things are at. So basically, every person who does enter will get a set prize, and then each Friday what we'll do is we'll do a draw of about 15 other people who will then get a pick of what's remaining on the board, so in a reverse draw. And we'll do probably do 20 the first Friday, and then the next Friday we'll do the remainder. So the incentive is in there to get it in as quick as you can, this survey. There's some coaching vouchers in there, social media support. There's all sorts of stuff that we're getting help from all our corporate partners. So when we get this survey, it's not just the crappy little old survey that we all get asked all the time. This is going to be the real baseline for the Indigenous business sector that we can use to, like I said before, to provide that scaffolding around there, but also it's going to be asking some questions about some opportunities you think might be out there that we can then identify and work out, okay, do we need to set our group up to talk about exports? Do we need to start concentrating getting exports ready for overseas? Other businesses that want to scale up, do they need some help with acquiring capital or investors and things like this? So look, it is going to take you a while. It's probably going to take you about 10 to 15 minutes, I think, James. Would that be safe?
Yeah, I think roughly, yeah. You're on a 20-minute mark.
10 to 15 minutes. So it's not a big part of your day, but it is a very important survey, as I keep mentioning. And like I said, there's lots of prizes, over $60,000. Everyone's a winner. It's like that clown game at the show, mate, where you put the balls in the hole of the mouth of the clown. Everyone wins a prize. So, and we've done the team behind the background has actually done a lot of work to get this up and going. So, keep an eye out for your emails today, and you'll get a couple of text messages over time. Please participate. The thing with surveys is, that a lot of people, half of people may even open the email. What I'm saying is I want you to go look for that email, and I want to get as many as our 251 certified businesses to do as accurate as they can, because, again, this is going to form the way the future is for Kinaway, but also what sort of support we can provide everybody out there. And look, we've got update on some other things, like you've probably seen over the last couple of weeks. We've had a couple of new staff members start on board. So a new project coordinator in Jessie Motlick, which is fantastic, taking a fair bit of workload off me. So looking after all our projects and ensure that we're reporting on them correctly, but also the way that we implement those programs and allocate resources. And then also very happy to have Liz Little on board. We've got her from the Department of Jobs, Precincts and Regions. Most of you people out there will know Liz. You probably spoke to her at some stage. Working for the government department provides a lot of our funding, but she's come across to be our Women Business Sector Development Manager. So that's a great opportunity and the idea she's got in that sector in particular is going to be really exciting for all the Indigenous women out there wanting to get into business. And then thirdly, we've got Kayla Cartledge starting in December. Now, Kayla's coming on board as my partnership relationship manager. So she'll be working with all our corporate partners and government about identifying those opportunities where we can actually tap in Indigenous businesses in the supply chains. And also we've got a couple other roles coming up, which I can't say too much about at the moment because I think government's going to announce a couple of things around the budget time, which is next week. And once that happens, I'll have some really exciting stuff to share with everybody.
Absolutely, thanks, Scott. And this is a survey that we're really proud of. I know you mentioned Jesse and Liz have joined us, and they've been put to work. All of us, been really working hard to get this survey together. So, it's really going to benefit us here at Kinaway, and it's going to benefit our members also. So, thanks for joining us this morning, Scott, for that announcement and those news. And to those who tuned in this morning, thanks to all. We hope you'll enjoy this morning's panel discussion, and don't forget to keep an eye out for these upcoming webinars. If you do wish to attend, please jump onto the Kinaway website to register your interest. And again, if you wish to catch up on the previous Kinaway TV panel discussions or webinars, jump onto our Facebook and YouTube channels where you'll be able to access them. Until then, don't forget to leave a like on today's video, subscribe and turn on the notifications to receive Kinaway updates, and keep an eye out for this survey as well. Thank you again to all who joined us today, and we hope you have a good weekend.